We're here in studio with Bundeep Rangar, the co-founder and CEO of Pi Protocol. Bundeep, great to have you on Crypto Weekly. You know, we talked a lot on the show about the future of stablecoins and future, RWA, real-world assets. From your perspective, how do you see the future of stablecoins and real-world assets evolve with everything going on in the broader crypto ecosystem?
Henri, great to be here, first of all. Look, I mean, this is really the killer app of the blockchain, right? Because this is the bridge between assets that you and I know, which we'll coin as real-world assets. For example, this TV studio, this is value. This is a real-world asset. If I was to tokenize this and make this something that was fractionally owned, I can't price this in Bitcoin or Ethereum because it's too volatile. If you'd priced this last week, it'd be up 4% today, right? So you need to have something that's pegged to a currency that doesn't fluctuate in the real world, which is a fiat currency. And for the most part, the largest currency that's there for world trade is the US dollar. So a stablecoin is effectively pegged to the US dollar for that reason. Last year, $28 trillion worth of transactions took place in stablecoins. 40% of all blockchain-related transactions last year took place in stablecoins. The reason for that is exactly that. You need to price things for trading, buying, selling, and just pricing.
So when you look at what's happening today in 2025, do you think that we're entering a phase of higher utility-driven DeFi?
Really interesting question. So look, there is a utility for sure. And when you look at stable coins, what they allow you to do, if you take a tokenized real-world asset, is aside from buying and selling, you do things that replicate the non-crypto world for finance, i.e. decentralized finance. What does that mean? I'm buying, I'm selling, I'm taking your studio. By the way, I've just tokenized that for you in case you hadn't realized that. And now I'm going to use that as a collateral to borrow. Well, if I'm going to borrow, I'm going to borrow with a stable coin. So anything that involves leverage, borrowing, selling, liquidity provisioning in the blockchain world will involve a stable coin. That's utility. Now, the difference is, if you look at the early entrant in this space, Tether, which at this time was fantastic, last year made $13 billion of profit. 72% of their reserves, i.e. about $113 billion, went to buying US treasuries. So, what we decided to do with my co-founder, who's the original co-founder of Tether, Reeve Collins, is to change that model and make it more timely. Because Yahoo was great for its time, Google came along and improved on that version. You can say the same thing for Instagram and MySpace, for those of us who are old enough to know the internet, early days of the internet. So you want the utility, but you also want a share of that yield that's giving Tether $13 billion. So the next evolution of stablecoins would really be to have the utility for all these on-chain transactions, but also get a share of the yield because you're creating that value, and it should not go to a centralized company and its coffers. You should be partaking in that.
So basically, actually, the value creation is going from the company issuing these tokens to actually the users. So on that perspective, though, what do you think of the regulatory landscape around that particular topic? Let's say we move from stablecoins to yield-bearing stablecoins. Well, how do you think the regulatory regime need to adapt or even try to put some kind of framework on this type of new asset that we may see rise?
Yeah, I mean, the one test that's been there from the early days of crypto, and I've been there for about 10 years, is the Howey test. And the Howey test would stipulate, is this item, this token, deemed a security? Now, if you look at it as a classic yield-bearing stable coins definition, well, that would be a security because you're getting an economic benefit. If there's an interest, a dividend, a royalty payment, that makes it a security and not a pure utility token. Now, that would require regulation in current frameworks because you need to know who's transferring that, who owns it. So therefore, the know your customer, the anti-money laundering checks, all are things that are subject now to these yield-bearing stablecoins. We've created a model where we use a page from traditional finance, which is called coupon stripping, where you strip out the yield, and therefore you create a token that has yield, and you create a separate token which is no longer a security token by definition because there's no interest paid out to it, and you create a stable coin that's there purely for its utility. And therefore, you have to map your business model to the regulatory changes. The regulatory changes are somewhat predictable given traditional finance is being copied on on-chain finance.
In your opinion, what kind of regulatory changes or shifts are we looking at for 2025 now that Mr. Trump is working on a lot of these themes?
Great question. So, the ushering of a new regime in the U.S. is now an ushering of a a sea change in the crypto world. And I think what's going to happen is we'll get a lot more certainty. Because unfortunately, in the past, what you had in the US, which is still the dominant economy in the world, was regulation through enforcement. And that made it really difficult. You would go out there, put something out, before you knew it, you're on the right side or the wrong side. And if you're the wrong side, you got fined or worse. At least now we're getting a sense of clarity. There's going to be legislation, the Genius Act, there's stablecoin legislation coming through. Europe has put something together called MiCA, which is the marketing and crypto assets regime. If the US wants to make it the home of the digital asset world, they're going to have to provide some really good clarity for cryptocurrencies, including stablecoins this coming year.
So actually on that topic, there's a lot of happening on the stablecoin ecosystem, real world assets, yield-bearing stablecoins. Obviously, they need to be built on an L1. Do you believe we're going to continue, we're going to see a revival of Ethereum, which is still the dominant player in the space, or other L1s like Solana will really take over and probably eclipse what we had with Ethereum? Or it's a third player that will come in and really come win this race of L1s?
Yeah, this goes back to what we experienced in the non-crypto world, right? We want things that are faster, cheaper, and therefore arguably better, especially if they're scalable. So the challenge is just the way Ethereum challenged Bitcoin, and they came up with smart contracts, and they came up with a layer for transactions. Solana, Sui, and various other coins are basically challenging Ethereum's dominance. They're doing so by making it cheaper, lower transaction fees, and arguably faster, more transactions per second, and by creating inbuilt modules that allow for scalability. So if you have new networks that make things better, that's the beauty of technology. Innovation just surpasses innovation itself. So if you can find more models that are improving on the status quo, why not? And Solana is one of the leading contenders.
Thank you so much, Bundeep, for joining us at Crypto Weekly. That was Bundeep Rangar, co-founder and CEO of Pi Protocol.
Are your children prepared for the future of money? Order Decoding Crypto with Henri and Hodler, the #1 new release kids book on Amazon.